Man, luck really seems to be on my side this year, because I just dodged a fucking bullet. Literally days after I made last month's video talking about how I had sold a bunch of my Coronado holdings because I was skittish about whether it would be able to hold on to its recent gains, they released an announcement detailing two different major disruptions to their operation. Neither of them were rain related, so my thesis about the El Nino is still in play, but rather they were two different non-weather incidents in different locations, both of which having a substantial impact on near-term production costs. One was a mechanical fault in a dragline, which is like a huge earth-moving machine. When I say huge, I don't just mean like big huge, I mean like huge. Like the cheapest dragline you can get is like $50 million. See this little white bit at the bottom? That is like 3 stories tall. They move a tremendous amount of material, and having one out of commission is a huge deal. Having to repair it, also a big deal. The other disruption was what they called an igneous intrusion, which I understand just means they ran into some rocks that were harder than rocks normally are, which is more of an inconvenience than anything else. But between these two incidents, Coronado's profitability was going to be substantially impacted in the near term, to the point where I reduced my price target for Coronado by 20 cents down to $1.90. The market hated the news even more than I did though. The price instantly fell off a cliff, down 30 cents over 4 days off the back of this one announcement, a 15% drop. Needless to say, I was very glad that I had already sold the majority of my holdings at pretty much the exact top somehow. I'm not even taking credit for that. Selling at the right time was just good luck, but hey, mechanical faults and geological anomalies are bad luck, so overall I would just say that I've broken even on the luck thing this month. I did still hold a small amount of CRN when the news was announced, and almost all of my gains on that parcel were wiped out, going from 20% profit down to a 6% profit in 4 days. But fortunately, for the majority of my holding, that 20% gain is just sitting in the bank. Now, you remember how I mentioned that the market hated the news more than I did? Well, I actually started to think it looked pretty cheap again after that big drop, so I bought back in. Yes, by pure luck, I sold the exact top, the price dropped 15% in 4 days, and then I bought right back in. I swear I'm not day trading. This is just a pure coincidence. My price target is $190 now. The current price is $168. I just thought it was a decent discount. I did not bring my holding back up to its old size because I had other more attractive opportunities to put the money into, but I doubled my holding back up to $18,000, which is pretty much the average holding size in my portfolio. So that's how the month started, and then followed another 4 weeks of the market getting slammed. Our benchmark ETF, even after including a huge dividend paid out during the period, minus 3.8% return for the financial year to date. Meanwhile, I actually managed to make money during the period, again, bringing us up to a third period in a row of outperformance. Speaking of which, check out my new graph. This one shows the market performance versus portfolio performance for each episode this financial year, except the first episode because I hadn't implemented the history feature that the script required to track this kind of thing, so the first episode performance is just kind of rolled into the second episode. So you can see we have market performance, my portfolio performance, and then the third line is portfolio performance minus benchmark performance. You can think of this line as representing how much I'm beating the market by. So even if the portfolio value line goes down, as long as my outperformance line goes up, I'm accomplishing my primary goal of beating the market. Obviously, I would prefer to always make money, but I'm not confident in my ability to predict and avoid market downturns, so there's always going to be months where the whole market gets smashed and my portfolio gets dragged down with it. Instead of timing the market, my strategy is to just pick good stocks and to stay mostly fully invested throughout the whole business cycle, even bear markets. That doesn't mean ignoring global risks, it just means moving your money into places you're more likely to be insulated from them. After the Coronado incident, most of the month was pretty quiet, with a few very notable exceptions. One of those exceptions was Tamerwood. In the first episode, I mentioned that they were a well-run, slightly profitable residential construction firm that was well-positioned to benefit from the recovery in the construction sector. Despite the huge increase in interest rates, home prices have barely even hiccuped. This is the CoreLogic Daily House Price Index, which shows us how house prices have been moving over the last year. As you can see, there was a very slight decline in house prices during the thick of the most aggressive rate hikes last year. But despite that, and despite interest rates being at cycle highs, the capital city aggregate price index is substantially higher than it was 12 months ago. If that's what happens during a 4% increase in interest rates, then imagine what house prices are going to do if we see a rate cut. Anyway, the point of all this is that if home prices are high, construction demand is high. Most of the recent construction industry crisis that saw massive numbers of builders going out of business was due to supply side issues. There was a labor shortage, there were high material costs, there was also a broad failure by most of the industry to hedge against interest rate risk, and when rates were hiked 400 basis points in record time, debt-laden builders started imploding one after the other. Those factors, while still present, are subsiding somewhat. And even when all those factors were at their peaks, Tammerwood still managed to turn a modest profit that year, a sign of a company that is managed with discipline and foresight. Labor availability is still low, but it's increasing due to small increases in skilled migration, and because now Tammerwood can hire all the tradies that used to work for their competitors who went bust. Interest rates are likely not going to rise further, and the final risk, high material prices, is something that my portfolio is already a little bit hedged against by having exposure the whole way up the construction supply chain. I have raw material exposure in Coronado and fabrication exposure in Big River Industries and Capral. The housing shortage is also a major political issue. There is substantial government interest in increasing funding for construction and increasing the size of the labor pool. All of the stars have aligned for this company, and I am very optimistic for its future. When I first purchased Tammerwood, it was trading at a PE multiple of 35, which is utter trash if you expected earnings to remain stable, but I was extremely confident that its earnings would increase to at least pre-crisis levels. If they did return to pre-crisis levels, then we would have been looking at a PE multiple of 11.5, which is quite respectable. However, I expect its earnings to grow substantially beyond pre-crisis levels. I don't really know how high they can go, so I'm mostly just holding on for the ride and we're going to see what happens. This month's investor presentation included some unaudited results for the first quarter, and they're looking very good. Their profit after tax for the first quarter was $2 million, which is already greater than the first quarter profits they used to post in the pre-crisis years. However, there's clearly some amount of seasonality in this industry which I'm yet to understand, because historically the first quarter has usually been more profitable than subsequent quarters. As such, I'm not letting myself get too excited just yet. With many companies, I would just naively annualize that first quarter result by multiplying it by 4, but with this company, it truly seems like we aren't going to get the full picture until we get the next 3 quarters results over the next 9 months. In any case, this result mildly exceeded my expectations, and I bought a few more shares off the back of the news, bringing my total TWD holding to 15,000. I would honestly rather own a bit more than I do, which brings us to what happened on October 26th. Yes, believe it or not, that huge jump at the end of the chart was not after they announced their big increase in profits. Those results came out mid-month, and they were very good, and the price didn't do a whole lot, and I was able to buy a bit more, at roughly the same price that I got in for. Then, as the month was drawing to a close, a lot happened kind of all at once. On the morning of the 26th, literally 2 days before I locked in the month's results to start producing the video, I got an SMS alert from my broker saying that Tammerwood was reinstating their dividend of 16 cents per share. The whole announcement was literally 2 sentences. This was good news because sitting on profits is no good. If you sit on them, they just get eaten by inflation. The fact that they chose a dividend over a buyback or an acquisition didn't really matter to me. The most important thing was the fact that they had acted fast to do something with the profits that would benefit investors. I expected the price to rise off this news, so as soon as I received the SMS, I logged into my broker with the intention of buying more Tammerwood before sellers could pull their orders. However, as soon as I logged into my broker, I was greeted with something even more urgent. BIS was up 8% on the day. I had already been planning to downsize my BIS to take advantage of other opportunities, like, for example, buying more Tammerwood. And I could not have asked for a better opportunity than this. I slammed the sell button, sold off half my holding at the ask price, and pushed the stock down 2% in the process, but it was totally worth it. I had locked in a 19% profit on the half of my BIS that I sold, and I could now use that capital to buy more Tamarwood. Except, by the time I was done doing all that, Tamarwood had rocketed up more than 10%, making me substantially less excited to buy more. What's more, the spreads on Tamarwood are fucking colossal at the best of times. Buying any quantity at the ask adds almost 5% to the share price, but right now, all the sellers had vanished into thin air. The market depth is a ghost town, to the point where if I had bought a full 5,000 shares at market, it would push the price up 20%, which almost makes me want to do it just for the flex. Almost. In the end, I've placed a bid to buy a bit more at $2.19, and we'll see if I get a fill. If it doesn't fill, that means the share price is up and I've made money. If it does fill, that means I successfully bought the shares I wanted and I'll make more money later. So it feels like I'm winning no matter what happens over the next few weeks. My price target for TWD is roughly the pre-crisis price of $3.40, which would be more than a 50% gain on my entry price. However, if they do substantially increase their earnings over pre-crisis levels over the course of this year as I expect, then it's possible that it could go to $4 or even more, depending on how much earnings growth we see. So right now my strategy is just to hold it for 12 months for the capital gains tax discount come hell or high water, and once the 12 months is up, we'll see how much we've made, compare that to the business performance, and decide whether we want to continue holding or not based on that. Thanks to some last-minute outperformance by BIS and TWD in the last 2 days of the reporting period, we have just barely made money this month, despite my largest holding CAA giving up some of the gains that accrued over the last few months. This brings the year-to-date portfolio performance to 9.77%, with the benchmark performance being minus 3.8% over the same period. While we made less than 1% this month, with the benchmark being down over that same period, I would once again classify that as crushing the benchmark. Overall, that makes for 3 consecutive periods of crushing the benchmark, with a year-to-date outperformance of 13.6%. This has exceeded all of my expectations. As somebody who earned more than half of his wealth from a single investment, I have a little bit of imposter syndrome about whether I just got lucky with the lithium boom and I wouldn't actually be able to keep up my outperformance into the future. That's why starting this year and documenting it with this series, I've started focusing more than ever on reducing my risk profile and having a diverse portfolio to provide consistent returns instead of a more concentrated feast or famine approach. For someone who is worried about just being a monkey on a typewriter, seeing a 13.6 outperformance in 4 months using a relatively low-risk investing approach is extremely vindicating. I still don't know how well I can maintain this performance into the future, but I am starting to wonder if maybe, just maybe, I might just be really fucking good at this. Anyway, thanks for watching all the way to the end. I've got a few more instructional videos planned which cover some basic investing concepts on top of the usual portfolio updates. If that sounds interesting to you, hit subscribe, say hi in the comments, etc., and I'll see you in the next video.